In this video, we'll talk about the fundamental of foreign exchange trading. Foreign exchange or forex can be explained as a network of buyers and sellers who transfers currency between each other at an agreed price. It simply means an individual, companies and central banks convert one currency into another. If you have ever traveled abroad, then it is likely that we have made a forex transaction. In most cases, foreign exchange is done for practical purpose. The vast majority of currency conversion is undertaken with the aim of earning a profit. The amount of currency converted every day can make price movement of some currencies extremely volatile. The fact that forex is very volatile and that makes forex so attractive to a lot of forex traders, bringing about a greater chance of high profits while also increasing the risk. How do currency markets work? It's different from shares or commodities, where forex does not take place on exchanges but directly between two parties. In an over-the-counter OTC market, the foreign exchange market is run by a global network of banks. It spreads across four major forex trading centers in different time zones like London, New York, Sydney, and Tokyo. There's no central locations and we can trade foreign exchange 24 hours a day. It's also very difficult for investors to manipulate the market, as the market volume is way too large. In other words, no one can control the currency movements except government policy changes. There are three different types of forex market. First, spot forex market. Spot forex market is the physical exchange of a currency pair, which takes place at the exact point the trade is settled, or within a short period of time. Second, forward forex market. A contract is agreed to buy or sell a set amount of a currency at a specified price, to be settled at a set date in the future or within a range of future dates. Third, future forex market. A contract is agreed to buy or sell a set amount of a given currency at a set price and date in the future. Unlike forwards, a future contract is legally binding. Base and quote currency. Base currency is the first currency listed in a forex pair, and the second currency is better known as the quote currency. Foreign exchange trading always involves selling one currency in order to buy another, which is why it is quoted in pairs. The price of a forex pair is how much one unit of the base currency is worth in the quote currency. Each currency in the pair is listed as a three-letter code, which tends to be formed of two letters that stand for the region, and one standing for the currency itself. For example, GBP over USD is a currency pair that involves buying the Great British Pound and selling the US dollar. For example, if the pound rises against the dollar, it means a single pound will be worth more dollars and the pair's price will increase. If it drops, the pair's price will decrease. Now, let's take a look on the few major currencies in the world. There are 7 currencies that make up 80% of global forex trading. They are US dollar, Great British Pounds, Japanese yen, euro, Australian dollars, Canadian dollar, and the Swiss franc. What moves the forex market? Foreign exchange is primarily driven by the forces of supply and demand, and it is important to gain an understanding of the influences that drive price fluctuations here. There are a few factors that we need to look into, which are central banks, new report, market sentiment, economic data, as well as credit ratings. Central banks. Supply is controlled by the central bank. It will have a significant impact on the currency prices. For example, like quantitative easing, which means printing and injecting more money into the market. It will drive the currency price down. News report. Commercial investors or other investors would want to put their money into a country which has a strong outlook economically. With a positive piece of news hit that particular country, it will encourage investment and increase demand for that region's currency. Market sentiment. It is often in reaction to the news, can also play a major role in driving currency prices. If the traders believe that a currency is headed in a certain direction, they will trade accordingly and they will convince others to follow suit, increasing or decreasing demand. Economic data. Economic data is also something that we cannot ignore when it comes to foreign exchange. It does give an indications of how one economy is doing, and it offers insight into what the central bank might do next. Credit ratings. Investors will always try to maximize the return and minimize the risk. Investors will tend to look for a high credit rating country where that country can potentially pay off their debts. With a lower credit rating, it simply reflects how a country may not be able to repay their debts and the price of the currency will be badly affected. We have come to the end of this video. We hope that you have gained the basic knowledge of the foreign exchange trading. Investing in foreign currency will potentially give us a very high return, but we must always bear in mind with the risk involved. High risk always give us high return.